Now let's turn our attention to options in a little more detail. We mentioned earlier the moneyness of options, and let's discuss that. We've got the exercise value of a European call, and this function over here, this max, that just means it's the maximum of 0 or this value right there. Well, what that does, it rules out any negative values. So if the exercise price is more than the spot price at option expiration, remember these European options are only exercisable at expiration date. The call is in the money. Remember, the call is the right to buy at the exercise price X. If the spot price of the asset in the market is greater than the exercise price, then it's in the money. The call is valuable because it gives you the right to buy at a below market price. So if that is positive, then the value of the call is that. If it is out of the money, that is, the spot price of the asset is less than the price that you have the right to buy it at. We say it's out of the money. This is negative, so the max is this. The value is 0. So if it's in the money, the value is the amount it's in the money. If it's out of the money, the value is 0. So that's all that fancy function is telling us there. The exercise value of a put, well, we have just the opposite relationship because the put gives you the right to sell at the exercise price X. So if you have the right to sell at X, and that's greater than the market price, then the put has positive value. It's in the money, and the value of the option is the amount it's in the money. And again, if it's out of the money, because the spot price you could sell it at in the market is greater than the exercise price, which is the price you have the right to sell it at with the put, then you wouldn't exercise the put. The max value is 0, and it expires worthless if it's out of the money. And we refer to the intrinsic value as the amount that it's in the money. So the intrinsic value is either the amount it's in the money if it's in the money, or 0 otherwise. Never negative, because you never have to exercise an option. You only exercise it if you choose to, if it's in the money, if it's valuable to you to exercise it. And the option price, or premium, we say then can have two components during its life. During its life, its value is its intrinsic value, the amount that it's in the money, plus the time value or speculative value, because it's still got time to run. At expiration, it's worth its intrinsic value. There's no time value left. The longer the option has to run, the more time value, because there's a possibility, the potential, that the value is going to increase between that point and the expiration date of the option. So what are the factors that affect option values? Well, we've got 6 of them here. For European options, it's the asset price and the exercise price. Well, we've looked at that and that relationship, right? If the asset price goes up, call options are worth more, put options are worth less. At a higher exercise price, that's great for a put option. You've got a higher price to sell it at, but that's not good for call options. The exercise price is higher. That means you have the right to buy at a higher price, which is less valuable. Another thing is the volatility of the asset price. And when we think about valuing assets, stocks, bonds, things we've looked at before, the more volatility, the more risk, the more of a risk premium when we discount that value, so we don't like volatility. With options, it's just the opposite. More volatility is better with options. Higher volatility increases the value of both puts and calls. The time to expiration. Typically, the longer time, the more time value, the more valuable the option, although there's some exceptions we can discuss. The risk-free rate enters into it, as we'll see, And the sixth point, any cash flows from or costs of holding the asset. And specifically, we want to talk about options on stocks that pay dividends, so that holding the asset gives you additional benefits, these cash benefits from holding the asset. So let's summarize these again. You need to memorize these. Best way to memorize them is to understand why they're true. So a higher asset price increases call values and decreases put values. Well, the right to buy at a fixed price is better when the asset price goes up, and the right to sell at a specific price is not as valuable when asset prices go up. And the exercise price, same story. A higher exercise price decreases call values because you've got the right to buy, but at a higher price. Exercise price increases put values. A higher exercise price on a put, a higher value that you have the right to sell at, the more valuable the put. As I mentioned, volatility increases both call values and put values. How about this longer time to expiration? Well, we said in general, it increases both call and put values. One way to think about this, we talked about volatility increasing both put values and call values. And then we talk about longer time. Well, volatility is really per period of time. So when we talk about volatility, we're talking about volatility over a time period. Well, if you double the time period, you've got more volatility. The same token, for a given time period, you could double the volatility. And they really both have the same result. That's what I'm trying to get across here. So they're very much related, and that way you can remember that, yeah, more time or more volatility per unit of time both increase put and call values, increase the value of options in general. The exception that I mentioned, for European-style puts under some conditions, that is, for puts that are only exercisable at expiration, if there's a long time to expiration, or if risk-free rate is high, or if they're deep in the money, then perhaps longer time would not increase the value. Think about this on a put. I buy a put, gives me the right to sell the stock at 50. It's a European-style put. I can exercise it 9 months from now. Well, if it's in the money, say this stock price falls to 0. Well, it would be $50 in the money. Its intrinsic value would be $50. And let's say further that it goes to 0 because there's just no expectation it's ever going to be worth any money at all. Well, now we get our $50, but we're going to get it 9 months from now at expiration. What if we said, well, we can lengthen your time to expiration so you couldn't get your $50 for a year instead of 9 months? You see, now, what is it worth? It's worth the present value of that future payment. The longer time to expiration, the further out in the future is that payment, the lower its present value, and the lower the value of the put option. Now, for the risk-free rate, an increase in the risk-free rate increases call values and decreases put values. And I don't think it's easy to explain, at least I don't have a way to make it easy to explain the intuition of this. But one thing you might think about is with puts, you're going to get money in the future. And if you're going to get money in the future, a higher risk-free rate lowers its present value. So that goes along with this idea of a higher risk-free rate decreases put values. Now, with a call, I'm going to make a payment to get the asset in the future. Well, what's the present value of that payment? Well, a higher risk-free rate means that the money I pay when I exercise the option, the call option in the future, the present value is less, it costs me less. That means that the call values increase when the risk-free rate increases. Okay, we've got two more here, huh? No. Cash flows to the underlying. Cash flows to the underlying decrease call values and increase put values. Easiest way to remember and think about this, I believe, is to think about a stock that's going to pay a dividend during the option's life. So I own a call option on a stock at 40, and it's trading at 40, and then it pays a dividend of $2 a share. Well, we know when a $40 stock pays a dividend of $2 a share, the day it goes ex-dividend, the value is going to fall by $2 a share. We're pretty darn close to that. So that's why it decreases the call values. I own a call. It gives me the right to buy this asset in the future. But to the extent that that asset throws off cash, it decreases its value, it makes it less valuable in the future, and decreases the value of a call option. A put option is just the opposite. Say I've got the right to sell it at 40 with a put option. It pays a dividend and drops to 38. That's all good news for me because I'm going to get the difference between its value and the put price. What about carrying costs? Well, that's going to be just the opposite, and I think that's the easiest way to remember that. So think about the cash flows, think about a dividend during the option's life dropping the price of the asset, and you can keep those first two straight. And if you've got the first two straight, well, carrying costs are just the opposite of getting cash flows, and so you get the opposite relationship there. Now we're going to derive put-call parity for European options. We're going to use our arbitrage situation. So we want to define two things. We're going to look at a protective put, and then we're going to look at a fiduciary call. And these are both portfolios, combinations of things. So the protective put is we buy a stock and then we buy a put at exercise price X. Now the payoff when you buy a share of stock, okay, so over here we have asset price and we have the payoff, not the profit, but the payoff at expiration. So this is the asset price at expiration on the horizontal axis, and the payoff is on the vertical axis. So what if we bought a share of stock? What would our payoff look like? Well, this is the stock price, the asset price, so it's really just the 45-degree angle here. Here's the payoff on a stock. Now, what else have we got here? Well, we bought a put. Well, what does this put say? This put says if the price is less than the exercise price, you get the exercise price for the stock. So that added to that. Of course, beyond here, the put is out of the money. It expires worthless if the asset price at expiration is greater than the exercise price. So the only part we have to change is this part down here, and we'll say, well, for any price below the exercise price, the payoff is the exercise price because you've got a put, you've got the stock, and you have the right to sell it at X. So now, if I clean off my beautiful artwork here, we see that the payoff diagram on a protective put is just like this. The minimum you get is X, and if the price of the asset at expiration is greater than X, you get dollar for dollar that. So that's why we say this is the payoff diagram for a protective put. And this covers all the various asset prices at expiration. Now the next one we want to look at is a fiduciary call. A fiduciary call says, well, we're going to buy a call, okay, and we're also going to have the present value of X. Well, X is the exercise price of the call. That's the price you have the right to buy it at. So now, at prices less than the exercise price on the call is worth 0. So this piece is worth 0 if the price is less than X, if the stock price is less than X at expiration. In that case, your whole payoff is this. However, what is that? Well, that's what we would have to spend to buy a risk-free bond that would pay the exercise price at expiration. So we've discounted the exercise price, say it's 50. So we take the present value of $50 and buy a pure discount risk-free bond, and that bond pays what at expiration? Well, it pays X. It pays this exercise price of 50. And so that's why we have this piece right here. That's the range over which the call expires worthless, and our whole payoff is the maturity value of this pure discount bond at expiration. Well, what about at prices above the exercise price? Well, at prices above the exercise price, the call kicks in here, and the call pays dollar for dollar. If the stock is at 52 at expiration and the exercise price is 50, then we've got an extra $2 on top of the $50 that our risk-free bond pays us. And so that's why we get this 45-degree line up from there. The call pays dollar for dollar as asset price at expiration increases. Now, we're almost to the punchline here. This diagram is exactly the same as the payoff diagram we had on a protective put. So now we're going to claim, by the law of one price, arbitrage will drive the prices of these various pieces to levels such that buying a stock and a put has exactly the same cost as buying a call and a pure discount bond that pays the exercise price at option expiration. Well, because of our law of one price, if both of those have exactly the same payoffs at expiration, then they have to have the same price. Otherwise, there's an arbitrage opportunity to what? Buy the lower price side and sell the higher price side. If we were going to sell this side, we would short the stock and sell, be the writer of the put. Well, once we have that condition, we can rearrange it just using simple algebra and say, you know what, the put value of the put must equal the value of the call minus the stock price at that point in time plus the present value of the exercise price. Or we could rearrange it another way and say a call option must have the same value, the same price, same result as buying the put, buying the stock, and borrowing the exercise price at the risk-free rate. And I say borrowing because we've got this negative sign right here. We're short a pure discount bond. Well, that makes us, instead of the lender, that makes us the borrower. And then we say, well, you know what this is over here? This is a synthetic put. And this over here, it's a synthetic call. We can make something out of these three components that has exactly the same payoffs as a call option, so that's why we say it's a synthetic call. And the idea of put-call parity is that for there to be no arbitrage opportunities, all these relationships have to hold. Otherwise, if the call was priced too high, we would sell the call and we would buy the lower price side, the synthetic call. The payoffs on the right-hand side just match what we owe on the left-hand side, so we keep the difference, and that's an arbitrage profit. Now, there's also something called put-call forward parity. This is not as difficult as it might sound. We've got our put-call parity relationship, right? S plus P equals C plus present value of X. That's our put-call parity. Well, what we're going to do is we're going to go back to a result we had earlier and say that the asset price must equal the present value of the forward price. Now again, this is when we had no cash flows. This is when we derived this relationship. But given that that must hold, we can substitute the right-hand side of this for S in the put-call parity formula, so the first term becomes this. We put in the present value of the forward price instead of S, and it still must hold. So it's purely a substitution, the present value of the forward price for the asset price at time 0, or whatever point in time we're looking at this relationship. Okay, binomial model for option pricing. We aren't going to do too much with this at level 1. You will use it at level 2 to actually price some options or price bonds with embedded options, things like that. So it's very, very useful, and you'll have occasion to use it. But for now, let's just learn the pieces. Well, you know the binomial model. We studied that back in quant, right? We've got the up move. We've got, if you divide by the up move, 1 over 1.15. There you've got the down move. Now the difference, in our binomial model before, we had the probability of an up move and the probability of a down move. Here, we're going to use something called the risk-neutral probability of an up move. You're not responsible for this calculation here. You're responsible for knowing that we use risk-neutral probabilities. And we've used the risk-neutral probability of a down move, which better be 1 minus the probability of an up move, which it is right here. So once we have, and these risk-neutral probabilities, one thing you should notice from the way they're calculated, there's nothing about preferences in there, right? When we talk about no arbitrage pricing, we haven't said anything about anybody's preferences because it was a riskless arbitrage that we were looking at. And so that's a little bit the adjustment that we're making here. But you can see the up move and the down move, so the volatility enters into this. The risk-free rate enters into this, but we get these risk-neutral probabilities, and also we need a risk-free rate and we need the beginning asset price. And so those are the pieces that are going to go into making our binomial model for asset pricing. Okay. So here's our up factor, here's 1 over our up factor. Here's the beginning price, so it may go up to $34.50. It may go down to $26.10. So these are our payoffs under 2 different scenarios, 1 period out. This is a 1 period binomial tree so far. We can add more to it, and certainly you can get very complex with it, but we need to walk before we can run. So we've got 1 period here. And those are the payoffs 1 year from now. Well, what about those probabilities? Well, with an up move, stock increases to $34.50. We've got a $30 exercise price, so that is a payoff on a call option 1 year from today. We're looking at European style, so we don't have to worry about these interim values. They're only exercisable at expiration. So we're looking at those and saying, well, your call option at 30, if there's an up move, the payoff is $4.50. With a down move, the stock falls, well, it's out of the money and your option will pay 0. So now we've got either a $4.50 payment 1 year from now or a 0 payment 1 year from now, resulting from owning this call option. Well, now we need our risk-neutral probabilities. Well, we can multiply 28% times this and 71.5% times this, and what does that give us? That gives us the expected payoff 1 year from now. So we can calculate that expected payoff 1 year from now and then discount it at the risk-free rate. Why the risk-free rate? Because we used risk-neutral probabilities. And so now we've just valued that option. The expected payoff is $3.22. It comes a year from now. Let's discount it to the present value. Since we used risk-neutral probabilities, that allows us to discount it at the risk-free rate, divide by 1 plus the risk-free rate, and there you have it. We have valued this call option based on our assumptions about volatility and the size of an up move, and we've valued the option. Now, European versus American value, we've touched on that. We said that American options are worth at least as much as a European style option because they give you the option of a European style option plus something else. Well, that something else may have positive value, it may have zero value, but we know it doesn't have negative value because you never have to exercise the option. You can choose not to. So early exercise of call options is valuable if the asset pays interest or dividends. Remember my earlier example, we've got a $40 stock going to pay a $2 dividend. And let's say it expires, just to make it simple, let's say it expires 2 days after that. So now you've got a call option on a stock that's trading at 40, and you know that in 2 days that stock's going to be at 38, more or less. Then early exercise gets you an extra $2 because the market price of the asset when you exercise the call option and get the asset is higher, so you have a chance to sell while it's 40. If you have the call option, you don't get the dividend. All you see is the price go down to 38. So that's the basis for this statement here. Early exercise of call options is valuable if the asset pays interest or dividends, has positive cash flows to the holder of the asset. So what does this mean? This means that American options can be more valuable than European options if they're call options on an asset that pays interest or dividends. How about put options? Well, we've given that argument too. We said early exercise of put options can be valuable if they are deep in the money. If they're deep in the money, you've got a put option at 40, the stock's at 2, you're $38 in the money. Well, you'd like to have that $38, but with a European style option, you've got to wait until expiration to get your $38. Plus, you've got that $38 at risk. Price may go up, may get less valuable. So in that case, early exercise of a put option can be valuable. And if early exercise has value, then American-style options are worth more than otherwise identical European-style options. Well, that was some complicated material, and I hope that did you some good and helps you in your further study of options and other types of derivatives.